Hello and welcome. This is the Insurance Pro Blog Podcast. I am Brandon Roberts.
And I am Brantley Woodley.
And you are listening to the internet's favorite podcast about life insurance.
Oh boy.
And all the things that are in the world of life insurance.
Well, that's very specific.
That was bad. That was
great.
Yep.
Mm-hmm. Good
We
work.
rarely edit this. We probably won't edit that. So
Nah.
you can...
If it's up to me, it's not being edited. I can tell you that. Unless AI can pull that out of there, it's not gonna get cut.
Today we're here to talk about index universal life insurance, but we're here to talk about all the bad things about index universal life insurance.
Oh, I thought we liked universal. Why do we always talk about bad things? People will be like, I thought they sold life insurance, but all they ever do is talk about the bad stuff.
It's called sales qualification, sir.
Oh, okay. Full disclosure.
Mm-hmm. Mm-hmm.
Well, we're going to talk about the bad. We're going to talk about what everybody says are the bad things.
Yeah.
That aren't actually as bad as they say they are.
Right. The motivation for this, let's start with the depression first. So the motivation for this is that you and I have been at this for
longer than we should.
Decades.
Yeah.
It's more fun when you can say decade, but now that there's decades, it's...
Yeah.
Where did I go wrong?
I'm in my third. I'm cruising towards the end of my third decade. Yeah.
Yay.
Exactly.
And index universal life insurance has been around
I've been selling life insurance longer than I lived with my parents.
Look at that.
Yeah.
That's noteworthy of some
Yeah,
some regard. We're not sure what. Nobody really knows. But
I'm this close to moving back in. That's how successful it's been. That's my retirement plan. Mom and Dad, we're coming back.
Okay. I'm not even sure what I was going to say next now.
Sorry.
No, it's
too much
no. Okay.
Too much cold medicine for me.
That's right too.
I'm a little loopy.
So we've been here for more than one decade now. And
yep.
Index universal life insurance has been around for practically all of it.
Yeah.
So
it's been around longer than that, right?
The first policy was issued, I think, a little bit after you joined the industry, but
oh yeah. I see what you're saying. Yes. Yep.
So when it was new, which was even when I first started in this industry, like it was
still pretty new.
Was considered relatively novel.
Yep.
And there were
it was only offered by just a few companies back in those days.
Yep, but the adoption rate was quick. Like there were lots of products being rolled out by a number of different companies that were looking at it and decided for whatever reason they wanted to be in this. And so even when I started in the industry, index universal life insurance was newish, and there were all kinds of speculation about what this was going to do within the industry and to universal life insurance. And a lot of that speculation was not positive.
Yeah, it was all the reasons why this is going to go wrong.
Mm-hmm. And perhaps in my world, there was definitely a negative bias because I started with a very major whole life focused insurance company.
Meaning they didn't sell index universal life insurance.
They did not, and they weren't happy about its existence because it definitely compared favorably to whole life insurance.
Yeah.
So there was rampant speculation about what negatives could develop with indexed universal life insurance and universal life insurance in general. And now here we are decades later, and we look back on those predictions and we ask, did they come true? Or what evidence is there that it's coming true? And that's what we sought to sort of dig out today. Mm-hmm. And the evidence is a little scant.
Yeah. To say the least, yes. Mm-hmm.
So we tried to avoid the big hits, though they intertwine with a number of things that we're going to look at today. So complexity complexity and lack of control over the mechanics, illustration problems, underfunding causing problems as time goes on because of cost of insurance.
Yep.
Tax woes, and just a general lack of satisfaction over time when we look at persistency data. Those are the 5 things that we're going to look at regarding indexed universal life insurance today.
Yeah. And if you don't understand what any of those are, don't worry. We'll get you more confused as we go on.
Yeah. Hey, there is no better way to talk about dry, complicated, dense subjects than to record a podcast where you feel like you know less at the end of the episode than at the beginning. And that's what we promise with every episode.
Yeah. Complexity. Are we going to start there?
We're going to start with complexity. So the chief complaint here, moving parts, we're going to set that one aside for right now.
Yeah.
But one of the chief arguments regarding indexed universal life insurance is the fact that you don't have control over the chief mechanic that drives accumulation in the policy.
Mm-hmm.
So most products have an index that follows the S&P 500, and usually it has some sort of band that it operates in. So maybe 0, 1% in some limited cases, up to some cap. Maybe it's 10% or something like that. And you can't control the upside of that thing. The insurance company can reduce that cap, and there's nothing you can do about it.
Right. Mm-hmm.
Now, the way that we talk about that, or well, not us, but the way that a lot of people talk about the cap on an indexed universal life policy is the insurance company can basically, at its discretion, reduce that cap just because it feels like it.
Yes. And furthermore, they will do that too, so that they can make more money and you can make less.
Yeah.
I mean,
yep.
That's what they say, right? That's the insinuation.
That has been said.
Yeah.
That has been said more than once. Now, while it's technically not incorrect that the insurance company could just decide, we don't feel like having a 10% cap rate anymore, so 9. That could happen. It doesn't in practice. There's no evidence that any insurance company has just arbitrarily decided, you know what we want to do this year just to make everybody mad? Reduce the cap rate. The cap rate is absolutely set
to do that.
Yes. The cap rate is set at its highest possible level to create as much benefit as they can. Now, to address the issue of we lower the cap rate in order to keep more money ourselves, insurance companies are not allowed to do that.
It's not their money. I mean, the money that's in the index is not theirs. It's yours.
Correct. So. In addition to that, there is specific insurance law that says insurance companies are not allowed to speculate with options with general account money. So they cannot go out and pursue strategies with options just for taking gain. Options exist to hedge, to create some benefit. So what they're doing is using options to create the index account. But if there is excess, that is not bank error in your favor kind of situations. Right. We can't guarantee that in no situation the insurance company it never ends up with some excess amount of money because of the way that an index strategy may be set up. But that's not a strategy for them.
Right.
So it is not the case that they lower cap rates to keep more money. They lower cap rates because the parameters of what can realistically be achieved given market circumstances dictate where the cap rate's going to be.
Right. Which is largely influenced by interest rates and has nothing to do with the market.
If we take interest rates and volatility and line them up against where cap rates have gone, they match very perfectly.
Yep.
As interest rates have declined and volatility has spiked, that has had a negative impact on cap rates. Now, when the inverse happens, cap rates have gone up.
Mm-hmm.
And that we have absolutely seen unfold. Yep. Cap rates have gone down and they've come back up.
And to be clear, insurance companies don't control interest rates or volatility.
They do not. They
just operate within the bounds like everyone else does.
Now, there are situations where some companies have appeared to address the issue of cap rate setting less aggressively for the sake of the policyholder than we might argue they could.
Right.
So cap rate goes down and it comes back up, but it doesn't come up very much. And it certainly lags other insurance companies.
Mm-hmm.
That happens. There's always going to be winners and losers in every industry, every product. There will be good and there will be bad. And why management at certain companies doesn't try to come up with better strategies to increase cap rates on their products, in force or new, to compete more favorably with other insurance companies. I can't speak for the world here.
Yep.
It's an unfortunate circumstance when and where it does happen, but it is not a sort of conspiratorial thing behind the scenes of let's just reduce all our cap rates and keep the money.
Right.
Second to this is the creation of more sophisticated index accounts
Mm-hmm.
that are often criticized for being intentionally designed to look better than they probably will be.
Mm-hmm. Mm-hmm. Mm-hmm.
And this style of index account creation and bringing to market is not new. It's been around for 10-ish years at least. And it's basically the process of blending different asset classes or different indices in an effort to create different exposure or create a strategic benefit when certain asset classes don't work out as well as we would hope they would because of market forces.
Right.
Generally speaking, these are referred to very broadly as volatility-controlled indices. The concept, if we were to way oversimplify it, is most indexed universal life insurance policies follow the broad U.S. stock market to the S&P 500. And long term, that's a pretty good bet.
Mm-hmm.
But there are going to be years when it's not. And so, as a way to diversify exposure, we could incorporate indices that have other asset classes exposed that should maybe do better when broad U.S. stocks don't.
Right.
And if we look at historical data, we can cherry pick those assets. The problem is always going to be what happens moving forward. That's true of creating indexed accounts for IUL, as well as creating your own portfolio when it comes to how you manage your assets that have nothing to do with insurance.
Mm-hmm. Right.
Lots of people live under the assumption that stocks are risky, bonds are safe. It's a paradigm that goes back well before you or I were in the industry.
Mm-hmm.
The problem is that it's an oversimplification of how both of those asset classes work.
The paradigm of when you bought a bond and you just held it and collected the interest until it matured, which like 1% of people do now.
People don't do.
Right.
So the criticism towards volatility-controlled indices, or I'm going to use that term to kind of encompass all of them, even though they're not all volatility-controlled, has been they looked really good when we looked at the historical performance, but if we look at the past 5 years, they've been less impressive.
Right.
And there are even individuals who have attempted to analyze these indices and look at how they are performing now that they've been rolled out among a bunch of products.
Mm-hmm.
And data over the past 5 years has been underwhelming for a number of indices. But we have to be fair to the fact that if we look at like a 20-year historical backtest, especially as these things started to come out, we had a period of time where interest rates were on a constant decline. And any bond component to a volatility-controlled index was going to look really good.
Right.
If we now go from rollout to current date, we're in a period of mostly interest rate increasing.
Right.
Which means any bond component to a volatility-controlled index is going to look relatively bad.
Right.
One of the biggest examples that gets brought up, there was an article in Insurance Newsnet back in 2024 that covered some research on this, that was looking at the performance of a number of volatility-controlled indices and noted that they didn't do as well for the past like 5 years as they did for like this 20-year period prior to that.
Right.
And also called out the 2008-2022 timeframes Because 2008 was a time when the volatility controlled indices actually looked really great because they were positive. But 2022 was a time when stocks and bonds went down, so they both did badly, which means volatility controlled indices didn't do that well.
Right.
But we have to be fair to the circumstances here. 2008 was a time frame when the stock market fell very, very harshly. The bond market did not.
Right.
2022
was
was a totally...
There was a flight to safety in that, in that market.
2022 is a totally different story. So that doesn't mean that these things were manufactured to make 2008 look bad and then failed intentionally. It failed because circumstances aren't the same.
Right.
Doesn't mean they don't work. It just means that conditions haven't been as conducive.
Right. They were designed to protect from a very specific set of risks.
Mm-hmm.
A rapidly rising interest rate is not one of them.
Correct. Everything has a strength and a weakness.
Right.
And rising interest rates are a weakness to these things.
Right.
Because it can create a circumstance where both
especially
bonds
sharply
and stocks
rising.
go down.
That's what, it's very hard to adjust when things move very quickly.
Mm-hmm.
If it's gradual, there are some things that can be done, but.
Yep. Now, speaking to the issue of design to look good, there have long been criticisms about the way indexed universal life insurance is presented numerically to the unsuspecting buyer.
The illustration. Yep.
So in the industry, we call those illustrations. It's a voluminous document that that has some ledgers in it.
Yes.
And those ledgers are an attempt to project how things will unfold cash value and death benefit wise when you pay the premium.
They assume an interest rate.
Yep.
Mm-hmm.
And when it comes to indexed universal life insurance, there were a lot of really crazy assumptions that were made, especially in the early days.
Mm-hmm.
Because we had a static interest rate that was something close to 8%. Oftentimes, we would take a loan against that at a far lower interest rate. And we had this massive spread between the two.
Yep.
And when you assume that sort of thing is going to happen, magical things take place with respect to how much money you think you're going to take out of this.
You can put this money in and take all this money out.
Mm-hmm. But it turns out timing matters. This is one of the big criticisms people levy towards Dave Ramsey. Because he claims that you can withdraw like 8 to 12% of your retirement portfolio because the stock market's going to perform at 8 to 12% every single year.
Right.
But timing of those returns matters.
Mm-hmm.
And the reason 4% has been more the realistic number is because there is a lot of noise, a lot of volatility to the year over year returns. And so, yes, the average may look something closer to 10%, but that doesn't mean you can systematically withdraw 10%, not unless you can guarantee every single year you're going to get 10%. If you could do that, then withdrawing 10% is no problem at all. That math checks.
Right. Or if you know when you're going to die.
Yep.
I mean, there's that option too.
That works too. The same problem happens with indexed universal life insurance, though, because if we're assuming that you're going to get 8% index credit every year, which is very high, but if you're going to assume that.
And by the way, we used to see assumptions much higher than that.
Yep, we did. And you're going to assume that you can borrow money at 4%.
Yeah. Happy day.
That spread will absolutely work to create a monstrous income stream from the indexed universal life policy.
As you and I used to say, anything will work on a spreadsheet if you put the right numbers in there.
Mm-hmm. Mm-hmm.
That doesn't mean it'll work in real life, but
it's kind of like we used to. We don't really get this that much anymore, but there would be people who would come to the Insurance Pro blog and say, "Hey, I want you to model whole life insurance at like 4.5% and the stock market at 8%. Tell me which one's going to come out ahead."
Yeah, it's like I don't even need to.
I don't need to do anything.
I can save you and me the trouble. I don't need to model that. I'm sorry. It just cracks me.
It did happen.
Always.
More than once.
I know. That's what makes me laugh. If I bought a 12-pack and you bought a 6-pack, who has more? 12 ounce cans?
Did I get Colt 45 or?
Yeah. Are those 8-ounce cans, 12-ounce cans? What are we doing here? Yeah.
So really and truly, all of the efforts to change illustrations through regulation really speak to the income side of this. That's the kind of unspoken aspect to this. People think it's about subduing the accumulation piece. It is to some degree, but really it's getting rid of that uncontrolled spread between what we think we're going to borrow the money at and what we're going to earn on the money.
Just painting these totally unrealistic pictures of the future. Yeah.
But the problem, unsurprisingly, is as regulation comes, it says, hey, you can't do that. Insurance companies look at this and go, well, okay, but what can we do to still make this look attractive?
Right.
And that's, again, these are not unique things to the insurance industry. This kind of stuff happens in all kinds of other industries.
Sure. Show me a rule and I'll show you the workaround.
Right.
Yeah.
So the criticism here is
it's not as egregious as it used to be.
Yes. The criticism is that indexed universal life insurance lies so much and had to have regulation drawn up to stop it.
Yeah.
That's the insinuation. And look, we are aware of situations that we saw anecdotally where people were totally overestimating what was going to happen with indexed universal life insurance. But the level of foolish you need to be to have believed any of those figures,
right,
is quite unimaginable.
Yeah.
And I remember having some conversations with people years ago where they would get us a proposal for an insurance company because we didn't have ready access to the software at that particular moment in time. And they would make some of these ridiculous assumptions. And we're like, no, we're not doing that. Here's what it's got to be. And there was pushback telling us, well, this was approved. So by like state regulators. So like, if it doesn't happen, it's their problem, not yours. It's like, it's kind of my problem though, if I show this to somebody and they decide to buy it. So we're not going to do that. Our job is supposed to be smart enough to guide these people through the decision and letting them understand or giving them guidance on what is a reasonable expectation of this.
Right.
And if we fail to do that, then we have done a serious disservice to someone.
Sure.
That's not 100%. A product problem. That's not a product problem.
Right.
In addition to that, there is a certain degree of care that has to be taken between what is conservative enough to be reasonable without being so ridiculously low that this person is going to make bad decisions based on that conservatism.
Mm-hmm. Mm-hmm.
So, for example, if you're trying to get a certain amount of money in indexed universal life insurance and somebody says you should assume 4% as the index credit, and you realistically end up with 6%,
right,
then you ended up putting a lot more money into an indexed universal life insurance policy than you should have.
Right.
Which
or could. Possibly, yeah.
Right.
That could happen.
Which for some people may sound, well, where's the problem? The problem is that you have to make decisions and allocate in various ways that are reasonable. And we don't expect indexed universal life insurance to be the highest performing asset someone holds.
Right.
We don't even expect it to be the asset that's going to take them from like wherever they are socially, economically into some higher level of strata here. We don't think that's going to happen.
Right.
We're also pretty dubious on that happening with stocks for the most part, but it's far less likely to happen with indexed universal life insurance.
Mm-hmm.
So if somebody is trying to build substantial or adequate assets to retire, and we put too much money into indexed universal life insurance and not enough money into stocks because we made some weird decision about what the index credit was going to be, yes, they end up with more money, but they may have ended up with even more money had they had more realistic expectations about where things were going to go. So we have to be a little careful about how much we subdue the expectations here. If we're off by 1 percentage point on average, that's fine. If we're off by 2.5, that's a little bit more of an issue. And it becomes more problematic the closer we get to 0.
Right. Mm-hmm.
So the attempts to change the way these things get illustrated is understandable from the egregious income spreads that were assumed. But it is not, again, the conspiratorial sort of backroom dealing of how do we get these things to look great in a way that we have zero expectation of ever being able to deliver on.
Right.
We found no smoking gun on that end.
Mm-mm.
We also have addressed a few times the notion that the cost of an insurance contract goes up over time. And one of the persistent criticisms levied towards universal life insurance in general is that cost is uncontrollable.
Yeah.
And will eventually just completely cause failure of the policy. Now, we've demonstrated on numerous past episodes and numerous articles on the Insurance Pro blog that expense is actually fairly controllable. Because expense is based entirely off the death benefit, and you have control over that.
Right.
We showed just a couple weeks ago what happens when you set a universal life insurance policy up with adequate death benefit to remain compliant as life insurance versus when you give it way too much death benefit, and how that impacts the policy long term, but just how far you have to go in order to have a real problem on your hands.
Right.
Now,
yeah.
Decent warning for anybody in the consumer category listening to this. Insurance agents are compensated based on the death benefit that is put in force on a policy. It's that simple. So more death benefit means more money, more income for them. There is an incentive to find a reason for you to have more death benefit. And from a cultural standpoint, the industry has for a long time awarded the sale of more and more death benefit. One of the organizations that was at one time sort of the crowning achievement of insurance agents was membership in what was called the $1 Million Roundtable, which originally came to exist when people put $1 million of life insurance in force.
Yeah, because that used to be a big deal.
Mm-hmm.
Kind of like selling $1 million worth of real estate used to be a big deal. Now it's like you sold half a house. Congrats.
So there is a desire to try and put more death benefit on policies, sometimes with bad intent, but lots of times just because the culture of the things are you need a certain amount of death benefit. But when it comes to buying cash value life insurance for cash accumulation, if your death benefit goal is not met, it is not a good idea to just inflate your death benefit to get there. Not unless you have a very specific intention of meeting that with additional money being paid into the policy.
Right. Right.
The number of insurance policies that fail because of exploding expenses and underfunding, so to speak, is not well understood because there's no data that tracks it. But we also know the incidence of consumer complaint is extremely low among indexed universal life insurance policies.
Mm-hmm.
There's definitely people on the internet who have gathered stories, tens of stories, possibly hundreds of stories of people who have bought indexed universal life insurance. They ended up underfunding it, and they ended up with a problem as far as expenses increasing. But there are tens of thousands of these policies issued every year. So the complaint ratio on that end is not high and not indicative of any sort of full-scale problem going on.
You are correct.
Stunned silence.
Stunned
silence. What else
silence.
to say? Okay.
I mean, that's just one we've talked about so much.
Yeah.
It's just, it's an unfortunate byproduct of incompetence and or nefarious behavior by people in our industry.
Mm-hmm. Most of the time, it's incompetence. It's sheer incompetence.
The vast majority of what we've seen is incompetence. Yes. But people get hurt. And so,
I speak from a certain amount of bias. I'm going to admit that, but we've had people come to us who either bought or looking to buy indexed universal life insurance, and what they show us is woefully wrong. And we try to understand why it is this has been put together the way it is. And the answer is almost always, well, I told the other agent what I wanted, and this is what they came back to me with.
Yeah.
And I don't know why, but this is what they came back to me with.
I told them I needed $1 million worth of death benefit, and I had a $2,500 annual budget.
Yeah.
And this is what they gave me.
Mm-hmm.
It's like, well, that's not how I would do it if my budget was $2,500.
Right.
I get that you need $1 million, and we can walk through the logic of why you need that and make sure that's right. And I'll take it at face value for the sake of conversation that it is right.
Mm-hmm.
There's a better way for you to make use of your $2,500 budget. You don't buy an index universal life policy with $1 million death benefit and a $2,500 premium, because that's going to be a problem for you at some point. It's not a problem right now, but it will be a problem later.
And that point is very good to just take a brief pause to address, because lots of times people get stuck in this box of, I thought it was going to be indexed universal life insurance. I presented my circumstances and we tried to make indexed universal life insurance work for the circumstances. Sometimes whatever the option that you thought it was initially is not going to work for the circumstances.
Right.
So that's not a failure of indexed universal life insurance. That's just a mismatch of product to what you need.
Right.
And trying to make...
Well, you can still buy an indexed universal life policy, but maybe that'll be a $150,000 death benefit, and you'll buy a $850,000 death benefit term policy.
Mm-hmm.
And that's how your $2,500. I'm just making numbers up, but you get my point.
Or maybe you'll decide that death benefit's really more important. And so I'm going to take as much of the $2,500 as I have to buy the term life insurance I need, and just forget about indexed universal life insurance for right now. That is an answer, and that is an acceptable answer.
Right. Exactly.
Next on the list is one that has a legitimate warning for anybody thinking about cash value life insurance in general. And that is the fact that the way that we distribute income from life insurance policies generally makes use of loans.
Right.
It's a fantastic strategy to create a non-income taxable income in retirement.
Mm-hmm.
But it comes with consequences. Those consequences and risks are very manageable, but they have to be understood.
Right.
And the big understanding is, if the policy lapses, you will have, in the year of the lapse, a tax liability for any gain that is recognizable from that policy. And that gain could look something like, or will look something like, all of the cash that was distributed beyond cost basis, plus all of the interest that was added to the loan.
Mm-hmm.
Technically, you had all the cash to begin with, but you encumbered it with the loan and the interest. You may not be in receipt of much cash in that situation. You may not be in receipt of near enough cash to pay the tax liability, but it will be due immediately in the year of the lapse. The best recommendation is don't lapse the policy.
Right.
But it is well worth understanding that is something that needs to be thought about when it comes to this strategy. Now, I will argue, I've argued for 20 years now, that risk is way overweighed by the benefit of tax-free income in retirement.
Yeah.
Life insurance brings that, plus lots of other things to the table. And if you die with this loan outstanding, all of this goes away. So that's cool.
Yeah.
But you have to understand that risk.
Mm-hmm.
And I'll just point out that if you're talking to an insurance agent about doing this sort of thing, and the answers to your questions seem a little unsatisfactory, this is the person that you are going to hand the responsibility of managing this risk if you move forward with them.
Right.
Just think about that for a minute.
It'll come to you. Yep. All right, last one. We're deep in the bonus round here.
Yeah, we are. So there's a claim that 8 out of every 10 indexed universal life insurance policies are thrown out. Done. Canceled. Walked away from. They're terrible. This is the dirty little truth the industry doesn't want you to know.
80% of people who buy a policy give up on it.
Yep. The dirty little secret behind that claim is we can't find any data to support it.
Where does that come from?
No.
I don't even know where that comes from.
It sounded good, so somebody made it up at some point. Well, it's kind of like that 2% of term policies pay a death claim.
Yeah.
I, again, tried to find the source of that, and
yeah. That one's more believable because of what we know about the cost structure of term insurance.
Yeah.
I think that's why that one's sellable.
Mm-hmm.
Even if it's like 5%, it's still like, okay. Yeah.
In fact, if we were to take lapse data that the industry does clearly publish and use that data to calculate what we think the real number of policies in force after 20 years is, like the math doesn't math.
You mean on IUL?
Yep.
Specifically?
Yep.
Yeah.
There simply isn't enough annual lapses that take place to get to 80% of them being gone after 20 years.
Yeah.
Let's not also forget that like 25, 28-ish years is the entire lifetime of indexed universal life insurance.
Right.
So how would we know?
Statistically, I can't say the word statistical significance is not really there at this point.
Mm-hmm.
I mean, when you compare it to whole life, it's like, we get like 200 years of 150 years of data.
In fact, if we look at Society of Actuaries and LIMRA data on lapses, non-secondary guarantee, that's the stuff where you pay a certain premium and you can guarantee the death benefit for basically ever. Non-secondary guaranteed indexed universal life insurance has a astronomically low lapse rate.
Yeah.
It's just not high.
Yeah. That seems reasonable. I mean, I can't imagine. I mean, I think about, again, I realize we have a small sample size because it's just the policies that we've written that we can see. And we also, there's a second part of that. We also set them up correctly.
Yeah.
And in our opinion, we design them. And I think our clients agree with that. That we design the policies properly. We have quite a few people who haven't funded their policies the way that they planned on it originally.
The power of flexible premium, baby.
Yeah. I mean, they decided for whatever reason, I'm not going to pay that premium as much as I thought I was going to, or whatever. Totally fine. The point is not that. The point is even without that, because the design was good to start with, they're not in danger of lapsing.
Nope. They're not.
They can support themselves. Now, whether they can support themselves indefinitely, that's a different matter. We're not at indefinite yet, but so far we keep our eye on them, and
we have control. Okay. We still have control. We can, if we run into a situation where we look at this and decide, hey, you got two decisions. You can either put more money into this policy because you've got capacity because you didn't put what you thought you were going to in there, or we're going to have to make a death benefit reduction.
Right.
That would be the prudent move to manage expenses and most conducively grow cash value moving forward. But we have control over those things.
Right.
Also, if we look at industry data about lapse rates across the board, they're all on the decline. People are keeping policies. So the notion that there's something unique to indexed universal life insurance and people are dissatisfied and getting rid of it, it doesn't track. There is no data to support that.
Right.
So here's the big thing. We were told
the punchline.
We were told. Punchline? Look at that. We waited till the end. Good for us. We were told that there were all these bad things that were going to happen to indexed universal life insurance because, and none of them have really happened. The complexity side of it, sure, there are some people who bought something they didn't understand and then discovered later it didn't work the way they thought it did. But there's lots of people who buy stuff every day who have that problem. It's not unique to life insurance.
Yep.
The illustration thing has tried to make things more realistic in terms of what we can expect. And there was a time when people made assumptions about whole life products and how they would perform that were woefully wrong. And there were much, much, much larger segments of the population negatively impacted by that.
Yeah.
Ultimately, a lot of these things that have been predicted have not materialized.
Right.
And now we're coming up on a time frame that's long enough that we should have seen something. There are pockets of little litigation here and there. We know about the circumstances with the Bush family and Pac Life. There were a lot of things that we could look at as being agent error in that situation, for sure. and some other things that were done that were serious head scratchers when it comes to even the suitability of recommending things the way they were in that case. There is pending loss or litigation with National Life Group for somebody who bought a policy and was caught very much off guard because index earnings have been practically zero since inception, where they were projected to be 7%
Right.
Again, not a problem with the product, just an issue with the index performance and market timing and stuff like that. Litigation is still pretty light here. And every time we see litigation, we can look at the facts as they're presented in litigation. We don't know all the facts necessarily, but we know what is presented in the complaint. And all of them point heavily to agents doing things they should have never done. And we don't see any sort of, well, the insurance company is just wholesale manufacturing an intentionally defective product to
No.
get money out of people.
Sort of counterproductive to their whole business model. I don't know.
Mm-hmm.
It's an interesting thing. Like, not every company, but like, many of these companies you and I talk about have been around for some more than 100 years, most of them way more than 50 years. But they just woke up on a Monday and decided, you know what? Today's the day.
Yep.
We're going to have one last hoorah. We're going to get all the money and then we're going out of business.
Yep.
It just doesn't work that way.
Well, my final thought of the day will be insurance companies are not politicians.
Right.
Yeah. What I mean by that is there has been a lot lately of people running for office who not long after they either win or announce their candidacy, people come out of wherever they'd been hiding to say that some years ago, this person did something really awful.
Right.
And those allegations come. Of course, they're always denied, but then not long after that, the individual decides that they should vacate their attempt to either hold office or be in the office that they're in. And you look at that, if you're me, and you think, what on earth compelled you to think that that would not come to light?
Right.
Thankfully, for the decades, even centuries of existence of the insurance industry, there has yet to be any skeletons in the closet of any insurance company on that magnitude.
Right.
So,
yep.
There is no there when it comes to the conspiracy.
Agreed.
And that's enough for today.
All right.
I am Brandon Roberts.
And I am Brantley Whitley.
And we will see you next week.